The three common ways to invest in commodities are: buy them directly in their physical form, buy shares in commodity companies, or buy indirectly through a fund or investment trust. Buying direct or investing physically means buying and then holding the commodity. It presents a storage problem, but many solutions are available. For example, there are several billion firms that offer not only online gold dealing, but also storage of the asset. Buying real gold gives you an easy access to the precious metal. Remember to buy only from reputable companies for your security. Check the website of the World Gold Council for a list of these companies. When you buy physical assets like commodities, it means real direct exposure to the goods. There are added costs to these, such as storage, insurance, security, buying and selling fees, etc. This means that as an investor, you need to buy them at a good price. It may be difficult if you are not buying mega bulk quantities. You may have little or no haggling advantage if you are just buying a small quantity. The second option for investing in commodities is to invest in commodity companies. You can deal in oil and gas by simply buying shares in companies such as ExxonMobil, BP, Royal Dutch Shell, or Tullow Oil. The same applies to other commodities, although your options might not be as wide in your country. Your investments will also be subject to the movement of the stock market and changes in the prices of the commodities. An investment fund is the most convenient way to access the commodity market. These funds also allow you a degree of diversity because they are invested in a variety of commodities. Other funds are invested in commodity-producing companies. Passive funds have gained popularity recently. ETPs, or exchange-traded products, have become a feasible way to access commodities directly or indirectly. There are also commodity exchange-traded funds, ETFs, that are equity-based and exchange-traded commodities, ETCs. ETFs invest in shares of commodity companies, while ETCs give investors exposure to commodities in the form of shares. ETCs track the price movement of an individual commodity and/or commodity basket. They can either be physically backed by the holdings of the commodity, or they can use swaps with other financial institutions. However, ETFs only monitor particular indexes such as oil futures. With this, there is little room to move. ETCs allow investors to short or leverage their investments, affording more space to maneuver. They can take bets on the prices either rising or falling. Being careful is key because although there could be potential gains, there could also be possible losses. That's it for now. On our website you can find more posts as well as savings calculators and other financial tools. I hope you enjoyed, and don't forget to subscribe to our podcast channel on YouTube. We would love to know your thoughts, so feel free to share them in the comments below.